Okay, let me open the question, page 90. Execute. So let's do the presentation through the Excel. Okay, let me just open our usual Excel. BQK, where is this? Here it is. Okay, this is company, coffee company. So the usual process, okay, first thing is to get to know where the money is coming from, capital source. Okay, the money for this company, simply going through the balance sheet, there's equity, there's preference share, there's bank note, okay, and there's a loan notes. So simply, there we can say equity, equity. Then you have next is 6% preference share. So your preference share. Shares. Next we have notes. And next we have bank loan. Okay, bank loan. Next we need to get the market value. Market value for each one of them. Market values. Okay, you need the market value for equity, which is equal to the number of shares of this company. The company has total, the nominal value of the company share is 15 million, and one share has the nominal value of $1. Therefore, this company has 15 million shares. Yes, okay. We multiply by the market value per share, and the market value per share on a dividend basis, 6.1. They will give us the total market value of the company equity share. Next is the market value of the company preference share. Okay. As per the balance sheet, the company has preference shares with a nominal value of 6 million. 6 million. Sorry, let me do it. Yeah, 6 million. Okay. And the nominal value per preference share is 0.5. Therefore, divide by 0.75 because that's the nominal value per preference share. And the market value is 64 cents. Therefore, times 0.64. They'll give therefore the total market value of the company preference share. Next is the notes, the bank notes. Okay, the nominal value of the note is 8 million. 8 million. Okay, that's okay. We multiply by the market value. We divide by 100, which is equal to 1.035. Okay, and you get therefore 8,280,000 to be the market value of the note. And lastly is the bank loan. Okay, no market value, so we use the book value, which is equal to 5 million. Okay, therefore the sum of the market value from all those four sources of capital, four finance sources is equal to 19,900. Okay. Next, to get the cost of capital from each one of them, cost of capital from each of those sources. Okay. So you begin the equity by getting the cost of equity. Okay. Based on the info you're given there, okay, you're going to be using the capital asset pricing model, which is equal to risk-free of the company is 3.5%, okay, plus equity beta for this stock is 1.25, Okay, we multiply by you being given the equity risk premium, or simply RM minus RF, which is equal to 6.8%, 6.8%. Okay, and then therefore give therefore the cost of equity. Okay, risk free plus equity beta be multiplied by the equity risk premium. Okay, therefore 12%. Okay, that's the cost of equity. Next, you get the cost of preference share. The preference share of this company, okay, they have a nominal value, so preferred dividend. So I can have the simple cost of preference share. Okay, so first you get the preferred dividend, okay, for this company, which is equal to preferred dividend for the company. It is paying dividend at a rate of 6%. So 6% we multiply by the nominal value, 0.75. Okay, the market value, so cost of preference share is equal to the dividend. We divide by the market value. The market value is 64 cents, 0.64. Okay, and therefore we get 7%. Therefore, cost of preference share, we refer to our working we have just done here, equal to 7%. Clear?
Sir, could you please repeat that?
Okay, let me just refer back. Don't forget the cost of preference share. Okay, let me refer to the formula, which you all now know. Cost of preference share is equal to preferred dividend. We divide by P naught. Okay, the preferred dividend is 6% of the nominal. The market value is 64 cents. Therefore, this is good. Therefore, what was the answer here? Okay, so it's the dividend here. We divide by 64 cents. Clear?
Yes.
Okay, great. Okay, so that's on how to get the cost of preference share. Next, we can look at the cost of the bond, okay, or the note, cost of note, cost of notes, okay, which will be equal to cost of note. So this note or this bond, they have a redemption, they are redeemable, and they can be redeemed at 10% premium to the nominal value in 5 years' time. Okay, the current market value is around 3.5, and they pay interest at 8%. So first, the interest payment per year of the tax, if there's tax, is equal to, they're paying at 8%, yes, 8%, okay, times with the nominal value of 100. Is there tax here? Yes, 20%. Therefore, the amount that remains of tax is therefore 80%, which gives therefore 6.4. Okay, therefore we can begin working from year 0. Okay, year 0. The redemption occur how many years from now? 5 years. Year 2, year 3, year 4, year 5. Okay, so currently these are the cash flows. Okay, don't forget to begin with the market value. So negative 103.5. Don't forget year 0 is negative. The negative market value year 1 is equal to 6.4. Okay, 6.4. I want to copy the formula all through, so that's why I need to lock the cell, so I can drag now all the way until year 5. However, in year 5, you're going to also be getting the redemption value, and in between the redemption value, it will be 10% premium to the nominal value, to give therefore 110. Okay, because okay, the nominal value is 100, therefore 110%, therefore give us 110 shillings. Having done that, the cost of this bond therefore will be equal to IRR. So equals IRR. We define the cash flow from year 0 all the way to year 5. And get the cost of this bond therefore to be equal to 7%. So therefore I can just pick my answer here, okay, and get 7%. Don't manually. I would propose that you don't manually copy the transfer the answer. Just pick it, okay. Equals, you refer back to your answer. So don't like sort of type here manually, okay. Just right here, you type here manually 7%, okay. Just pick from your working so that you don't end up making a transposition error. So avoid that, okay. Okay, that's therefore the cost of the bond. Next is the cost of this bank loan. Okay, the cost of this bank loan. The bank loan has a variable interest rate. Okay, is a variable interest rate. So we see that if you want to determine the cost of the variable interest rate, what do? You simply get the history of this loan. Okay, there's no history given. In this example, there is no history given to us. So what do? we determine, do we have another bond? Do we have another debt instrument this company has? Yes, okay, it has a bond, it has a loan note here with a cost of 7%. So we assume the cost of that other debt instrument is the cost of this bank loan. Therefore, we get it to be, therefore assume to be equal to 7% also. That here, Brian?
Yes.
Okay, great. Therefore, and last together we get therefore with the average cost of capital. Okay, to given us the weight of equity. Okay, we divide by the total market value. Okay, this is going to be the same all through. So let me lock it. Okay, then I multiply by the cost of equity. Okay, which is equal to 12%. For the contribution of equity towards the entire company cost of capital. So I have the formula here, and I can drag it across for the entire 4 capital sources. And of course, here is a total. Therefore, I get the sum from the first all the way to the 4th capital source. Therefore, 11%. Don't forget, I've done no percentages here. There's no percentages here. I've not tried to multiply any figure by 100. Don't do that. Okay. Otherwise, you're going to end up making mistake. Okay. So right now, in case you want, you can now convert into percent if you prefer. But don't feed manually, don't multiply any value by 100. Okay, attempting to convert it to percent. No, let's Excel pick the percentages itself. If it doesn't, like in the case of here equity, don't worry. Okay, there's no problem. Okay, but don't attempt to multiply a figure by 100 as you attempt to convert it to percent. Don't do that. Okay. Clear, Daisy? I thought Daisy was in class.
Clear. Yeah, it's clear, sir. Sorry.
Okay, great. Any question? Because I want to move out of this topic. Don't forget, as I mentioned, there'll be a question in the exam. Any question from this topic? It's all clear.
Sir,
Yes, Akina.
could you repeat why you say that 7%? You use 7% in bank loan.
Oh, the bank loan. Okay. So
Yeah.
this question, you've been told that we do have this loan is a variable interest rate loan. Have you seen that in the question?
Yes.
Okay, which means therefore we don't have it. If it was a fixed bank loan, we simply therefore get the cost of this bank loan to be equal to what you're paying to the bank. However, this is a variable; it is floating, so therefore it can fluctuate up and down. Okay, so what do? The first thing you can do is try to observe that this company, do we have the history? Okay, last year, how much interest did you pay on this bank loan? If we have last year you paid 4%, then you can assume that in future this year you pay roughly the same thing. Okay, so therefore you can assume the previous year's interest you paid will be the current year interest. We don't have that here in this example. So what do? The next step is determine, does this company has another debt instrument? Yes, it has. It has a bond. What's the cost of that bond? 7%. What do? We assume the cost of this bank loan is equal to the cost of the bond. Is an assumption you're making.
Okay. Yes.
Okay, great. Any other question? Sanya is clear?
Yes, sir.
Okay, great. Okay, next topic is on valuation. Okay, so there's some few topics here I've skipped, okay, which I think you may have to do on your own. One is on the dividend policy, which is very easy. And then you have other is capital structure, okay, which is very straightforward. The other one is on market efficiency, which is also a very easy topic, I think 2 pages or so. So let me go to the next one, the next topic, which is, okay, in quote major, not that it's too major, but in quote it's also a major topic, okay, which is on business valuation. So let's go on valuation of businesses. Business valuation. This one. Yes, this is what I want. It's already on the screen. Okay. Yeah, on business valuation. So when it comes to business valuation, we are going to be attempting to value company as well as the valuation of individual financial instruments, okay, which I think we have done a number of them. For example, we have done valuation of debt instruments, okay, valuation of bonds, we have done that already. So as per se, we have already done a bit of this topic already, okay, when it comes to valuation of debt instruments, okay. We should also discuss how do we do valuation of equity, okay, equity stock, okay, using the dividend valuation model, okay, which we have already gone through together when estimating the cost of equity, okay. So also not so new, okay. Then what is going to be new more is how do we value a company, not just one individual security, okay, valuation of company. Then our method we're going to use when it comes to valuation of equity, valuation of company. But the first reason, why do we need first to do valuation? Why do we need to do value of a company? Okay, I think we have done on acquisition, okay, I think in financial reporting, okay. Definitely you have company A wanting to acquire company B, okay. So you as the owner of company B that is being acquired, you want to determine what is my true value, okay. I want to do valuation of my company. I want to determine what's the value of my company, okay. Because you don't want to lose the money, okay. This is your company which you are selling, okay, which implies therefore you want to know what is my exact value. This person want to buy my company at, let's say, $100, okay. Is it worthwhile? Okay, $100,000. Is it worthwhile? Am I going to be shortchanged here? Okay. The same applies when the person is acquiring. You want to determine what should I pay for this company? Okay. We as KCB, okay, I think we want to acquire. We as I think Coop Bank, we want to acquire Kingdom Bank. Okay, I think it's a bank called Kingdom Bank. You as a Coop Bank, okay, cooperative bank, you want to acquire Kingdom Bank. Okay, this is Kenya, case of a Kenyan company. Okay, that has done acquisition there. I think this year. Okay. So you want to tell me, therefore, okay, what is going or what should I pay? Okay, you as KCB Kenya, you want to acquire National Bank Kenya. Okay, how much money should you be paid? Okay, this has already been done, by the way. Okay, where KCB has already acquired a National Bank. Okay, the controlling interest. Okay, but therefore, how much do I need to pay? Okay, for this company I want to acquire. Okay, you have to do valuation. Okay. Another thing that you want to do valuation is in case you're a company and you want to do flotation of your shares in the market. Okay, you want to become public. Okay, don't forget, becoming public means that you're going to be, you as the founder, you're going to be forfeiting a stake of your company. Okay, and external parties will come and become shareholders in your company. Okay, in your company in quotes. Okay, what implies therefore you have to know. Okay, if you're going to be letting go 30% of your company, what is the value of that 30%? You're trying to call upon the public to come and subscribe to your shares. Okay, so you have to know your company value. Okay, also in case of liquidation, definitely in case the company is closing down. Okay, you may want to know. Okay, how much money? Okay, if you have to close down the company, okay, if you have to break down this company, okay, how much can we as shareholder company be able to obtain? You have to do valuation. You as Taskis, you're closing down. Okay, what's your value? Okay. You have your relatives, your brothers, your sisters, okay, how much should each one of you take? Okay, because you're closing down, you have to do valuation of your company by the time you're going to dispose of the company. Okay, that way. Okay. Then also in case we have called mergers and acquisition. Okay, this is a merger, not acquisition. Okay, if you have a case of a merger where you have CBA and NIC. Okay, CBA is a bank in Kenya, NIC a bank in Kenya. Okay, so you want to come together to form one company. Okay, you want to go to the NCBA. Okay. So you as CBA, what is the value of asset that you bring to this in quote partnership? Okay, in quote this merger. Okay, you as NIC, what do you bring on board? Okay, so you have to do valuation to show that you as the original shareholder of NIC, okay, you're not going to go to a deal where you have been you're the one losing. No, okay. The same applies to the shareholder of CBA. Okay, you want to go to a merger, okay, that you're going to have your rate of ownership in the new company that you're forming after the merger. Okay, so these are reasons why you may want to do valuation, and many other reasons. Okay, in the case of, for example, in the case of matrimonial disputes. Okay, for example, you have divorce proceeding. Okay, which happened. That's the reality. You want to know, okay, what's the value? Okay, you as partner A, you as partner B. Okay, what's the value of whatever you own? You have to do valuation. Okay, if they own business, you have to valuation of the business that maybe the couples did own. Okay, so that's another reason for example, of valuation of company. Okay. As in case of partnership, for example, that's another reason. You want to introduce a new partner to the partnership, okay? So if the new partner, how much does he need to pay so that they become part of the partnership, for example, okay? If you're going to be a partner who is going to exit the partnership, okay, we want to know, we as the partner, we're going to remain behind in quote, okay? What therefore should we pay this partner who want to exit, okay, the partnership? All that call upon you to do the valuation of your business, okay? And the reason why you want to do valuation is to determine what are the different ways of doing valuation. Okay, there are a number of ways of doing valuation.
Sir?
Yes, yes.
What does float mean?
To float.
Yeah.
I want to mean you. This is what you want to mean. This term here to float here.
Yes.
Yeah, it's when you issue your shares to the market. What we call floating.
Okay. Thank you.
Okay, welcome. So when you're going to issue your shares in the market, okay, for example, you are a new company, which I don't know, you are Unga, I don't know, you want to issue more shares in the market, okay, so that's called flotation or floating your shares to the public, okay. Then you have a number of methods you can use when it comes to valuation of the company. One of them is called the use of the asset valuation basis or the net asset value method, the NAV, the net asset value method. Then you have the what we call income-based valuation. You can use two methods, P/E ratio as well as earnings yield method. Okay. And then lastly, you have called the cash flow-based valuation, which we may not discuss at this level. In the advanced FM, okay, advanced financial management, we will discuss then. My pen is gone. Okay, so anyway, so when it comes to the valuation, so the common method you normally use, okay, for this level is the first two method, the NAV as well as the use of the income-based valuation. So let's begin with the NAV, the net asset value method. So the NAV method, okay, the NAV method, this is where we are going to be using the company net assets. Simply, was the company excess of company assets over the liability, okay, referred to as the NAV. Simply determining what's the company, what's the total assets based on the company minus the company total liability. What remains is what referred to as net asset. As the name is suggesting, net asset. It is excess of the company total assets over company total liabilities. Therefore, it's simply referred to as the NAV, net asset value of the company. Okay. Generally, okay, we avoid including intangible assets in this valuation. Okay, we generally avoid including intangible assets such as goodwill in the valuation. Why? Because here the NAV is more or less trying to determine the company's value if the company was closing down. Okay, this is like what we call a case of liquidation. It's like a case of liquidation. Okay, so the company is closing down. It implies therefore goodwill will have no value going forward. But because the company is closing down, then goodwill, what value does it bring to the company? Nothing. Why? Because the company is not a going concern. Okay, the company is closing down, the company is liquidating. Therefore, going concern, therefore, goodwill, therefore, has no value at all. Okay, don't forget, goodwill has value if there's a business that is continuing operation. Okay, if anything, if it is not possible for you to sell off the company intangible assets, okay, in the market. If it is not possible for you to sell the company intangible assets, then don't use them. Don't forget, you're only going to be determining those assets within the company that can be sold off in the market, independently of the company. Okay, for example, motor vehicle. Okay, you can dispose of motor vehicle independent of the company, but you cannot go to the market to sell goodwill independent of the company. That can't happen. Okay. They have all those assets that therefore they don't have a value on their own. Okay, they don't have an independent value. Then we do ignore them when determining. We exclude them when determining the company total asset value. Okay. The only intangible we include in analysis.
So?
Yes.
But when we're selling off our business,
Yeah, we're not
so
selling. Yeah, we're not selling the business. We are closing down.
okay.
You get the difference?
Yeah.
Yeah, so we're not selling the business from someone else. We are actually liquidating the company. Actually, this is called the liquidation method, actually. In case sometimes it's referred to as the liquidation method. We are liquidating, not selling the company. We are selling off the company in parts, okay? Like selling motor vehicle in parts, okay? Selling the tires, selling the engine in part. Okay, going forward, that vehicle will not be operational. Okay, we are liquidating. We are selling the company in bits and pieces, in short. Anyway, so I was saying that in case you have intangibles, there's some intangibles that can have market value on their own. For example, patents. Okay, if you have patents on patents and copyrights, okay, if you do own let's artwork, okay, you do have, I don't know, what do you have? We have softwares, okay, you have copyrights to, let's say, books, okay, for example. It is possible to sell them off in the market, okay. If you have research products, okay, which was ongoing, you can decide to sell off the research to another company altogether. So if it is possible for you to sell those intangible assets, okay, and be able to fetch market value to get some value from them, then you can include them in the analysis. Okay, you can include them in the analysis. Those intangibles that they have their own independent value. In short, you can go to the market, tell the market, this is my copyright towards, I don't know, this particular asset, okay, towards this particular, I don't know, in code, let's a movie, for example, a song, for example, okay. So if they can go to sell the market that particular intangible, okay, then you can include that intangible in the analysis. All the other intangibles that don't have their own independent value, then you don't include them in the analysis. When it comes to valuation, when it comes to the use of the NAV, we can use three bases. Okay, one of them is the use of, let me go back, the historical cost method. We'll call the historical cost method. What do? You simply go to the company balance sheet, okay, the net book value, determine what is the NBV of the asset, what was the NBV of the liability, what was the excess of the asset over the liability. Simple as that. These are simply the use of the historical cost basis. Then you can also call the replacement cost basis, replacement cost basis. So in the replacement cost basis, what do? We are simply determining what if we, the company, was to do a replacement of its current asset, how much money would it pay? Okay, now we get it. Okay, if the company was to do the replacement of its assets, okay, for example, we have motor vehicle with a life of 8 years, okay, model ABC, okay. If you go to the market to buy a similar asset with a life of 10 years, 8 years, a model ABC, how much is the market going to be asking us to pay for that particular asset? So we do that for all the assets of the company, okay. How much is the market in code going to be asking, okay, going to be requesting us to pay for the asset or our assets in short, okay. Therefore, we come for the replacement value, okay, the replacement. The other method is called the use of the realization basis, okay, which is the commonly used method, okay, the realization basis. So here we are going now to go to the market and sell off this motor vehicle, okay. How much is the market going to pay for the motor vehicle, okay? How much is the market going to pay for the inventory you have, okay? In short, therefore, you're going to go to the market and sell off our assets. Okay, determine how much is the market going to be paying for our assets. We want to sell them off. So how much is the market paying for them? Okay, they call the use of the replacement realization basis. Is the commonly used method. Generally, therefore, okay, when it comes to the NAV, okay, you're simply going to be determined, therefore, what we call the minimum price of a company. Okay, the company value should not go below this. But if you are a shareholder in a company, if you have a company, then the minimum value that you can accept of your company, okay, is therefore given as the NAV. You cannot agree to get more, less than NAV, in short. Okay, so therefore it says therefore the minimum price, we call the floor value. Okay. Then, therefore, in case, for example, sometimes you can use the assets, okay, backing for the company shares, okay. You can also use the NAV, okay, when it comes to merger and acquisition, okay. That is in case, for example, in the case of merger, not acquisition, in case of merger, we have two companies, NIC and CBA, okay, bank coming together to form one new company. So you determine, okay, what asset you bring on board. You as CBA, what asset you bring on board, okay. It's not what the market perceives of you, okay. You want to form a new company, okay. That's true. It's not what the market will think of you. It's not about the market value. It's not about your market value. It's what you as shareholder of NIC, what asset do you bring on board? You as CBA, what asset do you bring on board? What liability are we going to be assuming as the joint company after? So therefore, then it makes a lot of sense. Therefore, okay, in the case of merger, okay, to ask you as A, you as B, what do you bring on board? Okay, simply it's what asset do you bring? Okay. However, as we mentioned, this method has its own limitation. Okay, as you mentioned, one of the key limitation is that we are ignoring the company as a going concern. Okay, for example, if the company was to be sold off to another party, that company is a going concern. Okay, which implies therefore we need to determine what's the going concern value of this company. Okay, which might be ignored by the method, which will be ignored by the method. Okay, so all the intangibles, okay, the goodwill, which has value. Okay, you having good employees. Okay, you having good and loyal employees of the company, good customer and loyal customers. So all these are intangibles, but they may not have a value per se. Okay, however, you cannot ignore them. Okay, they determine, okay, customer coming back again. Okay, which you can't quantify. Okay. I repeat, customer, they come back not because that you offer a very good product, no, but because maybe you have very good employees, okay, who are able to take into account the element of loyalty of the customer, okay. So therefore, it ignores many things, okay, which might have a lot of value impact to the company, okay. That's on the use of the NAV, okay. And as I mentioned, the NAV is simply total asset to the company minus total liability. Okay, so therefore the net asset value is equal to total assets minus total liability, both current and non-current. Then you have, of course, the use of the earnings yield method or the income-based valuation method. So the first one is called the use of P, which I think I've done in the past. Okay, so I simply go to the analysis. Okay. So if you consider P, okay, is equal to, okay, P is equal to MPS, we divide by earnings per share, or simply the company market value, we divide by the total earnings. Okay, to give therefore the company P ratio. If we have the earnings, okay, we can therefore be able to use to determine what's the market value of the company. Okay, if we have the P ratio, okay, because therefore the market value will be equal to the P ratio times the company total earnings. If you want to do on earnings on per share basis, therefore MPS, therefore earnings per share times the PE ratio. They both give the company total value. Clear? Okay, then you have next what we call the earnings yield method. The earnings yield method. In the earnings yield method, it's simply earnings yield is simply the reciprocal of the P ratio. Okay, earnings yield is simply the reciprocal of the earnings yield, the P ratio. Okay, with the earnings yield is given us the P divided by MPS, and the P ratio, don't forget what we just mentioned, is MPS we do earnings per share. So the earnings yield is simply the reciprocal of this method. Okay, which is therefore the company market value. Okay, the company or the MPS can be given us. The reciprocal is the earnings yield. You simply say the earnings yield. So that P ratio is MPS equal earnings per share. Therefore, earnings yield EYA is equal to the reciprocal earnings per share divided by the MPS. Therefore, MPS therefore is equal to earnings per share or earnings of the company, we divide by the earnings yield. Okay, if you have to use total earnings, then stroke here total earnings of the company together for the company market value. Okay, if however we do have growth in the earnings, which might occur, like just like the case of dividend, okay, we can have the growth in the earnings. Okay, you see apply the same formula. Okay, will be equal to market value of the company, therefore be earnings 1 plus G divided by earnings yield minus G, where G here is the annual growth in earnings. Therefore, you can have a case where the exam gives you growth in earnings and growth in dividend. Don't confuse the two models. Okay, don't confuse the two models. Clear? Anita, it's clear?
Yes.
Okay, great. Last method, which I think we have already discussed together, is the use of the dividend valuation model. Okay, P naught is equal to 1 plus Z Okay, K minus G, where P naught is the ex-dividend market value, G is annual growth in dividend, D naught is the most recently paid dividend. Okay, K is the cost of equity, and G is annual growth in dividend, which I think we did discuss together already. Brian, any question?
No.
Okay, great. Therefore, let's go to our question bank. Look, this is another area where you most likely have a question by your examiner on how to do valuation. Okay, so expect the question from the examiner on valuation. So let's go. I think in page 1 you have a question here. Page 1, question 1. Yes. Page 1, question 1A. Forbes company. Go through it. We discuss together. Page 1, question 1. I suppose therefore you're going through the question. So you've been asked to get here the value of the company, okay, using PE ratio and the dividend growth model. Okay, so let's do it together. Okay, this company is, what's the name? Forbes company. Okay, so you have the P ratio method. Okay, don't forget the P ratio method is simply MPS or the market value. Okay, you call it the market value. You divide by earnings, total earnings of the company. Okay, which means therefore the market value of the company therefore will be equal to the P ratio. Okay, multiplied by the earnings of the company. Okay, which therefore is equal to the P ratio of the company is equal to 10 times. Okay, the earnings of the company, which is the most recent earnings of the company. The earnings per share of the company is 40 cents. Okay, per share is 40 cents. Therefore, the total earnings of the company is 40 cents times the number of share, which is 5 million. 1, 2, 3, 1, 2, 3. I will give therefore what ought to be the company market value if we were to use the PE ratio, which is the PE ratio 10 times the total earnings of the company, which is 0.4, because earning per share is 0.4, and the company has 5 million shares. That's the use of the PE ratio method. Next method we meant to use is the use of the dividend growth model. Okay, the dividend growth model. Okay. By then, you don't need to show this formula as I've done here. You can simply go straight and say the market value company, and let me just show you what I mean. You can simply go and say market value company is equal to 20 million. You simply just show the workings you've done. Okay, that's it. You don't need to show all this. Okay, this is just for our own class argument. And for the company value, if you have to use the dividend model, is equal to D naught. Okay, so let me just do that. D naught is the most recently paid dividend. Okay, the company is paying. The company will pay. The earnings of the company. The earnings of the company is 40 cents today. They're paying 60%. Therefore, the earnings D naught therefore is the balance, which is equal to, which is simply 60%. Okay, times 60% times 40 cents 0.4. Therefore, the D naught. Okay, don't forget the formula. Let me just show you the formula. Is equal to P naught. The market value is D naught. Okay, 1 plus G. I think you've done this already. Cost of equity minus G. Okay, so D naught is, we have it here. This is D naught. Okay, 1 plus G times 1 plus G. The growth in dividend, we need to do that. So let me actually first do the growth in dividend. So let me have working here. Growth in dividend. Okay, G will be equal to the company. In the past 2 years, it has paid 20. The growth has been 23.3 divided by 22. Okay, minus 1. Again, the growth of the company, therefore the dividend to be equal, therefore equal to 6%. Okay. 23.3 divided by 22. Okay, here therefore 6%. So therefore 1 plus G. So times 1 plus G. We have done it here. Okay, we divide by P naught. P naught is the current. So we divide by RE minus G. Okay, so we divide by. So I need to have this entire numerator in bracket. But don't forget that. Okay, your entire numerator to be in bracket. So you don't end up making a mistake. And your entire denominator also in bracket. Okay, minus cost of equity. Cost of equity for this company, we need to get that. Let me get that first. Cost of equity of this company. Cost of equity for this company, okay, RE is equal to, you can use the capital asset pricing model, equal to risk-free, which is 4.6%, okay, plus equity beta 1.4 times the equity risk premium, which is equal to return on the market portfolio 10.6% minus risk-free 4.6%. The cost of equity equal to 13%. Let's go back here. This is a numerator for a formula here. We divide by, okay, cost of equity 13% minus G 6%. And they give therefore what will be the cost with the market value of the company. So up here, I need to multiply by the total number of shares because we want to get the total market value of the company, not per share, but total market value times 5 million share. 1, 2, 3. Okay. Together get 293 million. Clear?
So can you show the formula again?
Okay, there is a formula. Don't forget D naught. You have to work it out. Don't forget D naught is equal to 60% of the company earnings, which is equal to 40 cents. I think it goes 0.24. Okay. P naught. Sorry. Okay, they have to give us therefore P naught is equal to 0.24. The growth is 6%, 1.06 times the number of share 5 million. Divide by cost of equity 13% minus 0.06. This is what I've done here. If you think that you're going to make a mistake, then you can do bit by bit. You do D naught as working one, you do G as another working, cost of equity another G, whatever you prefer. Okay, but in case you're confident, then you can simply go and do it as single working. Clear? Sanya, is okay?
Yeah, so just why are we multiplying by 5 million over there?
Because we want to get the total. You don't want to get per share. You want the total company value using the model.
Oh, okay. Okay.
It's clear.
Yes.
Okay, great. Okay. If you're being asked to get per share, then you don't need to multiply by 5 million, but only the total market value. Okay. Question? Anita? Anita, question?
No.
Okay, great. So those are 11 marks. So how many? Discussing also the Dobby's company or the value created in company to the current market value. So
No,
okay,
sir, I didn't have.
okay. The current market value, we'll call the market cap of the company. Get given us the number of shares times the market value per share. Okay. The current market value is number of share 5 million. Those are 50. Let me move a 0. Yes, 5 million. We multiply by the market value per share, which is 3.3. So you need to compare, okay, these values here, okay, with the company current market value. Okay, there's a part for discussion. So don't forget the company current market value is simply like how market is appreciating of the company earnings. So how much the market, the value the market is attaching to the company earnings. Okay. So first of all, if the company was to use, if we are now meant to make a comparison, okay? That based on the dividend growth model, the company's value ought to be equal to 17.9. Based on the dividend growth model, or call the fundamental value of the company, ought to be equal to 17.9, okay? However, what does it mean? It means that the market is undervaluing this company, but the true value of the company, as per the dividend growth model, is 17.9. However, the market is giving a value of 16.5 million. Okay, therefore the company therefore is undervalued by the market. Okay. Now regarding the use of the P ratio, okay, to do the value, which is 20, we compare 16.5. What does it mean? It means in case a company was to be operating like other firm, the 10 million, sorry, the P ratio of 10 is not the company P ratio, is a PE ratio of the industry. Okay, I hope we go to discern that the 10 was the average for the industry. So if the company was operating like other companies, then its market value ought to be equal to 20 million. However, its value is 16.5 million. Now, what does it mean? I mean the company is not yet there. Okay, it's not operating like other firm. Okay, you need to see how can we be able to maybe improve the market perception of us. How much? Because don't forget the P ratio is simply how does the market perceive of your earnings. Okay, if the market appreciates you as a company, then of course what happens is that they have a high P ratio. Don't forget the P ratio is NPS divided by earnings of the company. Okay, so it means that you have a lower P ratio than the market portfolio, than the market entirely. Okay, the market doesn't value you much, doesn't value earnings. Okay, so you may have to see maybe the market doesn't value because either there's some things about you as a company with the market seem not to like so much. Okay. That's what you're meant to therefore to comment on the part of the discussion, because you're meant to discuss also. Don't forget, okay? So you've seen there below. You do that for 11 marks. Clear? Sakina, that's clear?
Yes, please can you show the formula?
The formula, okay.
Yeah.
Those are there. There you go. Brian, any
How did you get market cap?
Market cap.
Yeah.
The number of shares times the share price.
Okay.
5 million times 3.3, because the number of shares is 5 million, market price per share is 3.3. Given there the question. Clear?
Yes.
Okay, great. Brian, any question?
No.
Okay, great. No question. Okay. Let's look for another question. Now let's see the use of NAV. Okay, the use of net assets. Let's see if we can get net assets. Okay, we can do this one. Do it this quickly. This is NN Company. Which page is this? Page 24. NN Company, page 24. NN Company. So take a minute to go through it. We do part A. NN Company, page 24. So simply being asked here by the examiner to get the market value, the equity value of the company using the growth model, as well as use of the net asset value. Okay, this is page 25. Okay, let's present through Excel. That was 4Bs. So this is NN Company. So the company has just paid dividend of 66 cents per share because of equity 12%, growth in dividend 3%. The company per value, okay, 50 cents. Dividend market value is 8.3. Okay, So the company value, therefore, so this is the use of dividend growth model. The dividend growth model will be equal to the dividend of the company, 0.66. Okay, the number of share to get the total dividend. Okay, the company, if you go to the balance sheet, the company has a ordinary capital of 50 million. The nominal value per share is equal to how much? 50 cents. They have 50 million. Let me first begin number of share. 50 million to get the number of share. Oh, that's 5. That's too much. 1, 2. Yes, 50 million. Divide by the nominal value per share, 0.5. We multiply by the dividend per share to get the total dividend, 0.66. Therefore give the total dividend, 0.66. Okay. Don't forget P naught 1 plus G. The growth in dividend, so 1 plus G. Therefore, the growth in dividend has been equal to 3%, 1.03, 1 plus G. That's the numerator. So I have it in bracket. Divide by the denominator. Okay. Cost of equity of this company, you've been told, is equal to how much? 12%, 0.12 minus growth, 0.03. You close the bracket. And that's given for the market value of the company. If you have to use a dividend growth model, together for 755 million. NAV, the net asset value method, is simply total asset minus total liability. And here you've been told, yeah, that's total asset company. So there is no extra information. So it's simply therefore use therefore the historical cost basis. Simply the current total asset, which is equal to 143 million, 143 million, 123, minus the company total liability, which is current plus non-current. Current liability to company, 29 million, plus the company current non-current liability, is given there. Total liability 49 million. Okay, so I don't need to just simply minus 49 million, 123. Together for 94 million to the company NAV. Simply the company total assets minus total liability, 143 minus 49. Clear?
Sir,
Yes, Akina.
why do you have such a big difference between the two methods?
Yes, that's kind of for the limitation of the method. Okay, that they don't forget, as we said, the NAV is the minimum value of the company. If the company was to be disposed of, what's the minimum value they can fetch? 94 million. Don't forget, the method are going to give you very different answers for sure. Don't forget, here, first of all, there's no any going concern value, okay, because the company is closing down. But here, don't forget, is dividend growth model is about the future, okay. P naught is equal to D1, okay, divided by R minus G. So about the future of the company, okay, that the company, if the company was to pay the dividend going forward, company value, therefore, ought to be equal to 73 million.
Okay.
Yes, so there will be difference between the two companies. There'll be difference for sure, okay, between the share price based on the different method. So actually, I would propose you go to your textbook, okay. One of the pages the exam is trying to illustrate the advantages and disadvantages of each of the method. So I propose that you do that, okay. I'm not sure what page it is, okay, but there's a whole page where the exam is trying to illustrate the key distinction between all these methods. So take time to go through that page, okay.
Yeah.
So there's another question that has the use of realization basis. Okay, the use of realization basis. So let me see if I can boot it. That question. You're meant to get the value, the NAV. Okay, but now this is based on the realization basis. Let's see if I can get it. I don't know whether it's this one. Okay, you can also go through this. Close company, page that one, that's two. Close company, that one, that's two. Close company, that one, that's two. We do part A. Close company, page that one, that's two. Okay, so we can do it quickly. So we need to get the company value. You have to use the NAV method, you have to use the growth model, and you have to use the earnings yield method. Okay, so NAV method, total asset minus total liability. Okay. Okay, there's no dimension regarding the company asset, whether the BT is the company asset. So simply get the total asset of the company minus total liability. Okay, simply as per the balance sheet. So in 20, okay, so the in million minus the company total liability, which is equal to 410, which is equal to 40 plus 120 equals 160, therefore minus 160. These are therefore in $1 million. Okay, so dollar of millions. Simple as total asset minus total liability. Okay, if we have to use the dividend growth model, then this will be equal to the dividend the company dividend currently. If the company has paid total dividend equal to 40 million, so 40 million the company current dividend. 1, 2, 3, 1, 2, 3. Okay, so I think I can just use millions. So because I written there on top million, so let me just remove these thousands. 40 million. Okay. The growth in dividend is equal to 4% per year, 1.04. Okay, that's the numerator. D not 1 plus G. Okay, we divide by cost of equity of the company. The company cost of equity is equal to how much? 10%, 0.1, minus growth in dividend, which is equal to 4%, 0.04. Again, get 693 million to be the company value if we were to use the dividend growth model. Lastly, earnings yield method. Okay, earnings yield method. Earnings yield method, therefore, will be equal to the company earnings, which is equal to 66.6 million, 66.6 million, 1 plus G. The growth in earnings you've been told is equal to 5%, 1.05. That's a numerator. We divide by earnings yield. Sorry, this is a divide, not you divide by earnings yield, and the earnings yield is equal to 11%, 0.11, minus the growth by the growth in earnings, 5%, 0.5. And therefore, that should be the company value if we to use the earnings yield method. Let me just refer back to the workings I've done. Don't forget, okay, don't make that mistake of not putting, don't forget the numerator in bracket, the denominator also in bracket, okay? Otherwise, if you forget the bracket, you're going to end up with a very different answer altogether. So be careful. The working for the numerator in bracket, all of it. The working for the denominator also in bracket, all of it. Clear? Okay, soon it's clear to all of you. Great. I think this can act as our final question, more or less. This is GWW Company, page 4041. GWW Company, page 4041. Okay, so this question being asked to get the company value using a variety of methods. Okay, so I guess we can begin the first method. Okay, this is page 40. Okay, so we meant to use the market cap, the NAV, the PE ratio, and the dividend growth model. So those 4 methods. So we begin with market cap. Market cap, which is simply equal to the number of shares of the company. This company has how many shares? The nominal value per share is 50 cents. The total owned nominal value is 20 million. We have the number of shares, therefore 20 million. We divide by the nominal value per share, which is equal to 50 cents. Therefore, divide by 0.5. Okay. We multiply by the current market value per share, which is equal to 4. Okay, therefore, 160 million. Therefore, the company market cap. NAV using the liquidation basis, therefore, is equal to NAV is total assets. Okay, we've been told that from the sale of the company and current asset, they can only be able to get 86 million. Therefore, 86 million. Okay, so this value is in million. 86 million plus the company current assets. Okay, inventory you only get 4.2 million. So 4.2 million. Okay, then a receivable you get 80% only. Therefore, get 80%. So plus 0.8. Okay, of the current receivable value, which is equal to 4.5 million. Okay, that therefore give the company total asset. Okay, using the liquidation basis. Okay, get total therefore equal to 1. It gives us therefore 86 plus 4.2 plus 80% of 4.5 minus the company total liability, which is equal to current liability 4.1, which is 99. No. The company 99.3 is not the total liability. The company total liability is equal to 25%, 25 million. Therefore, minus 25 million minus current liability 10.1 million, and therefore 61 million. Like this in million. So this value is in million. Therefore, the company value using the NAV method: total asset minus total liability. Question? Okay, no question. Next, we can use the P ratio method. Okay, P ratio, which is equal to, you have to use the MPS. We'll get the MPS will be equal to, or the market value of the company is equal to the earnings of the company, company earnings. Okay, company earnings times the P ratio. As I mentioned, you don't need to show this formula. Okay, you don't need this. Which is equal to the earnings of the company. Okay, the earnings of the company. Do you have the balance sheet, P&L? Yes, in 2012, the company had total earnings of 10.1 million. Okay, therefore 10.1 million. Okay, we multiply by the P ratio, and the P ratio is equal to how much? 17 times 17. Okay, and get therefore the company market value to be equal to, okay, the figure is in millions, to be equal to 171.7 million. Earnings 10.1 times P ratio 17. Next, we get the company value is the dividend growth model. So first, we told that we assume, or that we use the historical growth in dividend as our G. Okay, therefore G. Okay, therefore G will be equal to will be equal to, okay, the growth in dividend therefore will be equal to in 2009 the dividend was equal to 5. In 2012 it was equal to 6. Therefore the growth experience is 5 to 6. Okay, this has been experienced over a life of how many years? There is experience of a life of 1 to 3 or 3 years. Therefore, to the power of a third, okay, to the power of brackets, don't forget to put the brackets, power of a third, 1 over 3 minus 1. Okay, therefore will give us therefore the growth in dividend. Don't forget the power also need to be in bracket. Okay, the power needs to be in bracket, and get the growth equal to 6%. Therefore, P naught, the market value company, therefore will be equal to, they will be equal to D, the dividend of the company as what 2012 is 6 million, 6 times 1 plus G. Okay, 1 plus G is here. Don't do it manually, don't copy it, just simply make a reference to the cell you just calculated. So don't put 6% to yourself. Okay, all that to be in bracket. Okay, we divide by the denominator here is equal to cost of equity. Cost of equity for this company is equal to how much? Cost of equity 9%, 0.09 minus, refer back to working, and get therefore the market value of the company is equal to 23.3 million. The next is to get the G using the Gordon's growth, where G as for the Gordon is equal to B, where
Can
B
you show the working again for the market value?
the market
Please
value.
show the working again. Yeah.
Okay, there you go. Okay, which is equal to 6 million times 1.06 divided by RE, cost of equity, 0.09 minus 0.06. But as I've done, don't forget. Okay, don't forget, I'm not these percentages. Here I'm referring to the cells, the working I've done already, so that I avoid any transposition error. Okay, so I will probably do the same thing. Okay, so as much as possible, avoid you feeding in the data if you can go to make reference to an already done working. And so here the G is the retention ratio, okay, times the return on equity. Retention ratio here, in 2012, I'll use the year 2012, which is the recent year. The company had an earning of 10.1. They paid 6. Therefore, they retained the difference, which is equal to 10.1. Therefore, they retained, okay, 10.1 minus 6, okay, out of the 10.1. That's what give us therefore the retention ratio. The company had earning of 10.1. They paid 6. Therefore, they retained the difference. Okay. Therefore, get that 41% more or less to be therefore the company retention ratio. Therefore, return ratio multiplied by return on equity. Okay. Therefore, let me go back here. I multiply this by return on equity. Return on equity is simply the profit we made, 10.1. Okay. Out of the earnings, out of the equity, the return on equity of the company is equal to net income divided by equity. The equity investment for the company for the year was 67.2. You got it? Let me refer back what I've done. Simply G is equal to B times R. What's B? Rate of retention was R, return on equity. Therefore, the company had earning equal to 10.1 million. They paid 6 million. That means they retained the difference out of 10.1. Therefore, this gives the ratio of retention time return on equity, which is equal to net income for the year, which was 10.1. We divide by equity, which was equal to 67.2 million. This is return on equity. Dog is given us net income or earnings of the company divided by equity. Earning from the P&L, this is from the balance sheet. Clear? Okay, great. I hope that's clear. Therefore, the market value company, okay, in millions, therefore, will be equal to the dividend, okay, which you already got, which is equal to the company paid 6 million. So 6 million, 1 plus G, 1 plus the growth in dividend. I'm not typing, I'm just making reference to my working, okay, divide by cost of equity. And so this, let me put them in bracket, numerator in bracket, denominator in bracket also, okay, so which is equal to, okay, minus the cost of equity, which is equal to 9%, 0.09, minus the growth, no typing, I refer back to my working, I close the bracket, and I get 219.61 million to the company value in case as you use the growth model, okay, where G is estimated using the Gordon's growth, the Gordon's approximation method. Clear, Brian? Is Brian in class? Yes, he is. Yes, Brian, is it clear?
Yes. Yeah.
Any question, Daisy?
No, sir, I'm fine.
Nafisa, question?
No, sir. Thank you.
Okay, great. Okay, fair enough. This.
So can you please show the formula again?
Here you go. Clear, Sanya?
Yes, sir.
Okay, great. And that's on the company value. If you use this method, don't forget, most likely be a question we examine on how to use this method. There's a question where there was a multiple choice question. You're meant to get NAV per share. Let me see if I can get it. NAV per share. I'm not sure that is I can find it. No, it's not here. I don't know. Let's just go manually. How to get NAV per share? It was a second A, second B question. You can see here the so this method. I'll pause it to try to go through them. Because this is section B type of question. Okay, we're meant to get the company value using the NAV, earnings yield. Where is the question? Okay, so what I wanted was a question on. It was type 8. It was under section A, I guess. Or you've been asked to get.
Sir, I got it.
Got it. What is this?
Page 64.
Page 64. Page 64. Okay. Page 64.
QK company.
Section A type of question, I hope.
Yes.
Section A, page 64. Okay, I think they are different. It's called what?
QK company.
Here it is, QK company. This one here it is. So you mainly has to hold the NAV per share for this company. Very easy, okay? Total asset company, which is equal to total asset is equal to 140 minus total liability, which is equal to 20 minus 15. 20 minus 20 minus 15 to give us 140 minus 20, that is 120 minus 15, which is 105. Therefore 105 million to be the company, the total NAV. We divide by the number of shares. This company has a share with a value of 0.5. Therefore NAV, total NAV, okay, is equal to 140 minus 20 minus 15. 105. Number of shares of this company, the equity is 25 million. One share is 0.5. Number of shares, therefore, is equal to 25 million divided by 0.5 together 50 million. NAV per share, therefore, is equal to 105 million divided by 50 million, and we get 2.1.
Yeah.
Okay, get 2.1. Simple, very simple question. Any question on that topic? Don't get, as I mentioned, most likely be a question by your examiner. Any question on that topic? Okay, no question, fair enough. Then we